Welcome back, everyone, to day 11 of our 100-Day Wealth Challenge Explainer. Today, we're unpacking a strategy that is an absolute game changer. It fundamentally shifts how you interact with the stock market. We're talking about dollar cost averaging, or DCA for short. If you've ever wanted to build wealth continuously without obsessing over the exhausting daily news cycle, well, this explainer breaks down exactly how to do it based purely on the data. So, let's get into it.
Okay, let's dive into this roadmap. First up, the market timing mistake. 2. Dollar cost averaging explained. 3. Turning volatility into wealth. And 4. Automating your wealth strategy.
All right, section 1, the market timing mistake. This right here is the single biggest error we see amateur investors make.
So when is the absolute perfect time to invest? Honestly, it's a question that completely paralyzes even seasoned investors. You know the feeling, right? Sitting on the sidelines, trying to predict the exact perfect bottom, or panic selling the second bad news hits. It's all entirely driven by this impossible desire to perfectly time your entry and exit points.
But here's the reality. Timing the market, whether that's waiting in cash or panic selling, is historically a losing game. Literally, even for professional traders. The real secret to building wealth, it's not about perfectly predicting the future. It's simply time in the market, getting in, and just staying there over the long haul. That's the secret.
Which brings us to section 2, dollar cost averaging explained. This is the ultimate solution to that whole market timing headache.
So, dollar cost averaging, or DCA, is exactly what it sounds like. It's the practice of investing a fixed amount of money at regular, scheduled intervals. You just pick a specific dollar amount, a specific time frame, and you commit to executing it, no matter what. This simple, completely hands-off approach is the absolute core of today's explainer.
And the source material highlights a really crucial dynamic here. It says, you invest, quote, regardless of whether the market is going up, going down, or moving sideways, end quote. Consistency is the absolute key to this strategy. You don't pause your investments because the news sounds frightening, and you don't double down just because everyone on social media is excited. You simply stick to the plan.
Now, what's really interesting about this next concept is how we actually use that chaos to our advantage. Section 3, turning volatility into wealth.
It is actually insane how effective DCA really is. Think about it. When market prices are high, your fixed investment naturally buys fewer shares, right? That makes logical sense. But when the market crashes and prices drop, that exact same investment automatically buys way more shares at a steep discount. You're literally buying assets on sale, and you didn't even have to analyze a single chart to do it.
Let's ground this theory in a real-world example. Imagine you decide to invest exactly $500 every single month. You do this on the first day of every month, without fail, like clockwork. With a DCA mindset, a market dip is actually a reason to celebrate. Seriously, you shouldn't panic when the market takes a dive, because your routine $500 just bought significantly more shares than it did a month prior. It's like your money suddenly went on steroids and is working that much harder for you.
And this brilliantly illustrates what happens next. During that market dip, you are heavily accumulating discounted shares while everyone else is panicking and selling. Then, when the market eventually recovers and hits new highs, which, as history shows us, it invariably does, the value of all those accumulated discounted shares just completely skyrockets. You maximized your buying power exactly when it mattered most.
The massive underlying advantage here is that dollar cost averaging completely removes human emotion from the equation. It strips away the greed that makes you buy at the absolute top of a bubble and the fear that makes you sell at the bottom of a crash. By just committing to that fixed schedule, you turn market volatility from a really scary threat into your absolute greatest wealth-building tool. All right, let's get practical. Section 4, automating your wealth strategy. Here is your exact, actionable playbook.
Making this a seamless reality in your own life really just comes down to a few clear steps. First, set up an automatic monthly transfer into your index funds. The key word there is automatic, so you aren't relying on willpower to log in every month. Second, stick to the schedule through every market cycle. Up, down, sideways. Just keep it running. And finally, step back and let the mathematics of dollar cost averaging do the heavy lifting. This is how you eliminate financial stress and invest with absolute confidence.
So the question is, are you ready to let math do the heavy lifting for your financial future? Because that is the undeniable power of time in the market combined with dollar cost averaging.
Thank you so much for joining this explainer. If you're ready to take control of your wealth and build it entirely stress-free, hit that subscribe button for FinFlow Media, and we will see you right back here tomorrow for Day 12.